back with Midcap Masala and good to have you back with us. Before the break, we were speaking with the management of Indigo Paints. Now let's put the spotlight on Awfis Space Solutions. We've got the management, the CMD, Mr. Amit Ramani, joining us on this show. Just taking you through what the numbers look like. It's a good set of numbers this time around. The revenue is up about 27%. The PAT has seen a growth of 2.4 times on a year-on-year basis. So that looks good. And we've seen a little bit of margin expansion as well. So let's talk about what these numbers mean. More importantly, what's the occupancy looking like? What are some of the clients and the client mix shaping up to be? Let's take that conversation ahead with Mr. Ramani. Hi, Mr. Ramani, morning and good to be speaking with you. You know, you've seen a very good quarter in Q1. What's the outlook on the kind of occupancy trends that we are seeing? What is your client mix looking like at present? And more importantly, what is your seat addition guidance for the rest of the year?
So thank you for having me on the program. I think clearly the numbers are fairly strong. And I think from an occupancy standpoint, we will see at least expansion in terms of occupancy. We are sitting at about 83% for the mature centers, and we are sitting at about 76% for less than overall occupancy. That 76 should certainly see a couple of points of movement there. In terms of seat addition, as we had guided, we would be adding about 25,000 seats. For the first for the first quarter, we have added approximately about 7,000 odd seats, right? So that addition, and we are clearly looking at another 5,000 odd in the next couple of months. So we are on track for the 23 to 25,000 seat addition for the whole year.
Mr. Ramani, morning, Shesha here. And while we are talking about seat additions, let's also talk about the demand that we are seeing from GCCs. How has that panned out and how much of the incremental demand is coming from this segment?
So GCCs has been a big boon for the whole commercial real estate industry, right? Overall, the industry has done fairly well. In the first, last year, we did almost 80 million square feet of gross leasing. This year, for the first, I would say for the first quarter itself, I think it's been a great year in terms of GCCs are now contributing almost 38% of the total demand for the network, right? So clearly GCC demand is growing fairly well. From our standpoint, we currently service 100 plus GCC clients. It contributes to about 24% of our overall revenue as a company. And we certainly have a key for the nano GCCs, which are less, the first time, and the nano GCCs, which are essentially less than 500 seat type of GCCs. We have a clear edge in that category. We also have closed a few 2,000 plus seater GCCs as well. So continuing to see a lot of expansion with the GCC growth in the country and for us as well.
Sounds good. Mr. Ramani, during the earnings, you did say that new premium centers can command about 30 to 50% higher pricing than your existing portfolio. Can you help me understand how much of this premium is already visible in your actual bookings and the deals that you are now striking with your very near future clients? And what EBITDA margin uplift can we realistically expect as your gold and elite centers are also now scaling up?
So if you look at the overall portfolio, currently we have close to about 242 centers that are live, including the ones under fit out. We have about 251 total centers. Gold and elite are about 37, right? So out of that, about roughly 13 to 14% of the portfolio today is the gold and elite centers. That certainly will see an expansion, and we hope to reach about 20% of the total portfolio by end of FY27. The margin expansion obviously is, because a large portion of the portfolio today is the flagship portfolio. So the margin expansion probably we'll have to wait for at least about a couple of more quarters before we start seeing some expansion. Hard to predict the exact impact on EBITDA, but certainly the EBITDA will see an expansion as we go forward for the next few quarters.
Mr. Ramani, can you put some numbers into perspective for us? I was just going through the realization figure. Blended revenue per occupied seat has come in at 9,710, which is a growth of about 8% YOY. Now with premiumization kicking in, with GCC demand surging, how is that realization trend expected to be over the next few quarters?
So as I said, hard to put an exact number to it, but certainly we'll see an expansion. Obviously, if you sell a seat at a 25, 30%, 50% premium, then that will roll back into the margins as well, right? So clearly, our focus has been for this year is clearly to do what we mentioned as partial managed office, which obviously helps mitigate some risk, where half of the center is given to a specific client, half of it is run as a co-working center. Our focus on Gold and Elite will obviously see some expansion as well. So without putting actual numbers, I think certainly there'll be a margin improvement overall in the portfolio.
Okay. And Mr. Ramani, you have said that the second half is expected to contribute disproportionately towards profit. Can you put some more context to this statement? What are we looking forward to in the second half of the year? Is it more deals materializing? Are you looking at more demand? Can you help me with the rationale here?
So I think we've done. Obviously, we mentioned that there was a bit of a blip because of a large client exiting in this quarter. So the next 3 quarters certainly look better than what is happening today for us. We are currently sitting at a very strong positioning when it comes to GCCs. Today, as I said, 100 plus GCCs, and in the last 18 months, we have closed about 25 plus GCCs with another 10 which are on the anvil. So very, very strong GCC portfolio closing is happening. Our transform business, which grew by about 25% year on year, has closed about 200 crores of order book already, with about at least another 150 to 200 crores in advanced stage pipeline. Last year, we did about 257 crores in that business. And today, in the first 5 months, we have closed about 200 crores. So clearly, I think there are a lot of tailwinds that are helping us this in the next few quarters. And that's why I mentioned that we obviously H1 and H2 are going to look very different as we go forward.
H2 is likely to be very strong. And Mr. Ramani, since you're talking about tailwinds, let's also talk about how you're aiming to capitalize on this. Are you looking to expand into other geographies, other cities? I believe you added about 7 centers in the first quarter itself. What will the expansion roadmap look like?
So the expansion roadmap, clearly, I think we are in 9 tier 1 cities, including Noida and Gurgaon, and we are in 9 tier 2 cities. At least from a city expansion perspective, we are going to hold our position right now. And, from our geography expansion, I think it's going to be going deeper into some of the micro markets that we discussed. I think in our discussion yesterday in our earnings call, we clearly have a leadership position in ORR, where we almost occupy 500,000 square feet. We occupy about close to 3 lakh square feet in BKC. So the idea is to go deeper into some of these tier 1 micro markets, which are extremely well sorted. And focus will be to continue to expand deeper into tier 1 and tier 2 cities where we exist today.
Okay, understood. The outlook looking bright. Mr. Ramani, on that note, thank you so much for your time. Congratulations on the quarter, and we hope to interact with you very soon once again. Thanks so much.
Thank you.
On that note, viewers, complete